Hello and welcome to the latest Retire Well episode with me, Matthew, and as always I'm joined by Joe. And today we're going to cover some questions that we've had on recent videos. It's been brilliant, some of the comments and questions that people have left. So as always, please share any comments or ideas you've got with us and we'll try and cover them on future episodes.
Yeah, absolutely. So I thought I'd start off straight away, Matthew, with what is probably the most common question I was asked towards the back end of last year with regards to, will the government ever reduce your tax-free cash amount that you're allowed from your pension?
Yep, good question. I think it seems to come round every time there's a budget and every time the political party wants to raise additional funds. Is the tax-free cash going to disappear? Personally, I think it would be a difficult decision for any politician to make because everyone has pensions and it would be detrimental to people. So it would almost be saying, okay, I'm happy for people to be impacted and I'm happy that I'm not going to get re-elected at the next election. So politically, I don't think it's something that will happen, but it is something that people have talked about and thought about. And in reality, when it comes to pension planning and pension rules, pension planning is a long-term approach and pension rules are focused on the long term. So if there was ever going to be a time then practically they wanted to reduce tax-free cash, I could see that being done as a phased approach to say anything paid into a pension before now benefited from 25% up to that tax-free cash threshold, but future contributions might accrue lower tax-free cash. And in theory, you could also have changes to tax relief on the way in. So you could have higher tax relief on the way in and lower tax-free cash on the way out, for example.
Yeah, I think I'm of an agreement. I was speaking to a client just last week about it with regards to their worries over tax-free cash. Again, I don't like having a crystal ball and trying to predict because you're inevitably always going to be wrong. But I almost see it as the government have pretty much had their bite out of pensions this term, given that pensions are coming in with IHT. I think that's one way that they've attacked them. Other than that, I think Matthew's 100% right in the fact that if anything does happen, it'll be similar to lifetime allowance protection that's come in when they've reduced the lifetime allowance down. So yeah, I think long-term planning for this is the key and don't have sort of knee-jerk reactions to sort of speculations on the budget.
Definitely, and I think in the same way, George Osborne announced pension freedoms and pension flexibility, and that allowed people to access pensions earlier, and that's been really good for people to marry up objectives and spending, and the government benefited from the additional tax revenue. So that was one thing that you could see a positive result for people and a positive result with the government. If they simply reduced or removed tax-free cash, where's the benefit for any individuals? Where's the trade-off? Where's the we've done this, but we've equally been able to give you that? So for me, on its own, it's significantly lacking unless there's more reforms on the tax relief side. Yeah,
absolutely. Next question I've got was actually probably already answered when I got to it, but I thought it was an interesting one to talk about anyway, and we can sort of quickly run through it. It's essentially one client has got sort of taxable income. His wife's only got £400 a month income, and he's wondering whether he can transfer his defined contribution pension to his wife to essentially pay less tax.
Yep, so when we saw the comments, they were perfect. The only way that you can really transfer a pension tax efficiently is on death and then potentially divorce. And again, we said we wouldn't recommend either of those. So in reality, what someone in that scenario could do is potentially use the marriage allowance. So they could be transferring 10% of her personal allowance across to him to use. But again, there isn't anything magic the way you can transfer a pension between two individuals when you're living in the same way you could with personal investments or ISAs. You could say, I'll cash that in and move it across. Or a personal investment, I can transfer it between husband and wife without any capital gains tax implications. With a pension, it's a legal entity owned by one person and you can't have a joint pension.
Yeah, absolutely. I suppose the only addition I'd have there is on the marriage allowance. It could work if he's a basic rate taxpayer, which most people are in retirement. Yeah. But if he's a higher rate taxpayer, you can't actually transfer marriage allowances over.
Yeah, it depends how much they're drawing down from it, exactly. And again, it could be an opportunity there where we've only got £400 per month was mentioned. Again, you might then say, well, there might be a state pension to come. State pension plus that £400 a month might put them over the personal allowance and they haven't got anything to transfer at that point as well. So yeah, certainly worth looking at. We had another question, which was quite an interesting one, of the most tax efficient way to draw down in retirement when looking at tax-free cash. And this was having an income need of about £41,000 and could draw taxable income from a pension and then tax-free cash to avoid paying tax and NI up to state pension age.
Yeah, so I suppose a couple of things on this pension. Just to clear up first, when you are actually drawing down from pensions, it's only tax you pay. You don't pay national insurance on the way out of a pension. But they essentially asked, sort of, can I draw up to the personal allowance with my taxable income and then essentially use tax-free cash to meet the other sort of 28,500 roughly that they needed to get that 41,000 income net. And I suppose there's a simple answer, it depends, but we'll try go into it in a little bit more detail. If you're using something like Flexi-Access Drawdown, the most modern style of drawdown, the answer is essentially yes. You'd be able to crystallise it in enough of your pot to get that 12,570 taxable income in there, and then top it up with that sort of 28,000 if you've got the tax-free cash available, and that would allow you to utilise your full personal allowance and then not use any more taxable income there, which would work great between sort of now and your state pension. If you're using an older style of drawdown or UFPLS, uncrystallised funds pension lump sum for short, and the maximum tax amount that you can get out of a pension like that tax-free in any one tax year is 16,760, and the way that works is that you'd crystallise that full 16,760. You'd get £4,190 of that tax-free, and then you'd essentially get the taxable amount of the personal allowance of 12,570. And I thought it would be good actually to look at the difference between Flexi-Access Drawdown, where you can draw that full 41,000 out net, and how much you'd have to draw out in UFPLS to get the same amount. So to get 41,000 net, you'd have to crystallise 45,278. There'd be just over £4,200 in tax there to get that 41,000. So I suppose that almost just reinforces what we've spoke about throughout the podcast of, if you are able to sort of look at your pension and draw it down in a Flexi-Access Drawdown, not only is it more flexible is it in that you can draw it when you want and how you want, it can also be more efficient from a taxable or tax efficient point of view.
Yeah, definitely. I think if I try and simplify that as best as I can, Drawdown has two taps, a taxable income tap and a tax-free cash tap, and you can turn them to different amounts to get where you want to be. UFPLS has that 75%, 25% relationship turned on with one tap essentially, and therefore in that scenario we've got Drawdown can perfectly get that individual to where they want to be, but UFPLS misses the mark because of those sort of rigid percentages.
Yeah, absolutely. I suppose we'll have a couple more on tax-free cash and then move on to some other financial planning, because I realise although tax-free cash is popular, it's not the only thing there. So Matthew, just with regards to sort of, I suppose, how to use tax-free cash, we did have one person ask sort of about using UFPLS. They suggested that they'd look at using that sort of lump sum of the 16,760 to essentially use that each year, draw it out in one go. And although they didn't pose a question, I wanted to pose a question to you on, would you draw it out in one go, or would you prefer to almost spread it out in monthly payments over the course of the year?
I think that sounds like you're trying to shoehorn something in to work for you. So you almost go, I can't necessarily have the flexibility I wanted, so I'll just take out a lump sum and then I'll budget myself through the year. What I would say back to that individual would be, what do you want? Ignore what the pension that you've got currently does. What do you want? The majority of our clients want a monthly income because that matches what they had when they were working, and you can then feel like you're spending some money and some more money is dropping into the bank account. So psychologically, that's perfect. But we do have some clients who go, okay, there's a few expensive months, so I'm going to take a lump sum then, I'm going to budget with those funds for the next few months, and that's going to supplement a monthly income. So it really depends on what that person wants and what their spending pattern is. But in general, I would say, the actual flexible drawdown can perfectly meet someone's needs, and it sounded in that example potentially like they were shoehorning, UFPLS as a one lump sum to say, oh, that's fine, I'll just have it as one lump sum and I'll use it throughout the year. And then the big negative that I think someone would jump on that and say would be, if you're doing that, potentially you've taken too much out initially and you could have actually left that fund to be invested over the year and continue to get some growth on it. So it's about matching your income with your needs, but I would say there's potentially more flexibility to be had for them.
Yeah, I'm the same. I always like to keep stuff in pensions where you can, or investments where you can, to benefit from that investment growth, and then just take it out either monthly or as and when you need it.
Yeah, I think some people were paid weekly, some people have been paid monthly, and I've had people who were paid quarterly, or business owners who draw dividends maybe twice a year. Again, those individuals might say, I want to match my pension to how I used to have income. So someone might say, well, I'm perfectly happy to have it twice a year and I'll just use it accordingly and budget. That's fine. But for most people, I would say a monthly income does have value.
Yeah, absolutely. So moving on to sort of define benefit pensions for a second, and Matthew, I'll pose these to you as a pension transfer specialist.
Yeah.
One thing that was picked up when we were speaking around sort of final salary pensions and your options available is someone essentially said defined benefit pensions don't always permit a DB buyout or a transfer to a flexible pension.
Yeah.
Do you just want to run through that a little bit and explain what that means?
Yeah, definitely. I think sometimes it's difficult to talk about these pensions generically because each scheme is a bit unique, but in general there's two versions. There's a funded version and there's an unfunded version, and with an unfunded version such as the NHS, teachers' pension, civil service, there's just a large pot of money which essentially the government are saying we're going to provide that guaranteed income for people's pensions, and therefore those members don't have the ability to transfer away because there's no large pot of money that's actually accrued for them. They're actually just, they're part of the bigger spreadsheet of how much it costs for the country and those services. So for them, they have the pension they've got and their only option is to take it through the scheme. When you look at other pensions, such as private defined benefit pensions from large employers or from local government pension, they do have the ability to transfer across. So they have, when do I want to take the scheme? Do I want to take full scheme pension? Do I want to take reduced scheme pension, tax-free cash? Or do I want to look at that third option of transferring towards a defined contribution pension?
Yeah, and I suppose the only other thing to mention there is, although you can't always transfer out of one of those public schemes into a DC scheme, if you've worked for a number of different areas of the public sector, there's a transfer club where you can sometimes transfer between schemes.
Yeah, and also one thing we should say is there's also times when it's not actually statutory requirement for a private pension to let you transfer. So for example, in the last 12 months before your normal retirement age, they don't have to let you transfer. The scheme trustees don't have to give you a transfer value and they don't have to give you permission to transfer, but practically we found lots of them do. But again, it's just the quirks that someone might say, oh, well, I found that I couldn't transfer. That might have been one of the reasons why the scheme said, okay, you're in your last 12 months before normal retirement age, therefore we're not expecting you to transfer and we won't let you transfer.
Yeah, and you mentioned CTVs there, or cash equivalent transfer values. There's obviously a number of different things that can impact them. We did have a couple of questions through about sort of what potential things can impact them, I suppose the main ones and also some other nuances. Yep,
so the main things that impact transfer values are interest rates and annuity rates. So when interest rates are high and annuity rates are high, the cost of providing that guaranteed income for the members is lower. So therefore the transfer values are lower. So when we look now at transfer values on average compared to where they were 5 years ago, when interest rates were really low, that's when the transfer values were particularly high, and we've seen them be at a particularly low point now. Transfer values. Other things that impact that can be life expectancy. So again, providing that guaranteed income for life. If life expectancy goes up, the cost of providing that income can go up. But when we saw with COVID, for example, average life expectancy came down, and therefore with that data, that would have impacted transfer values. There's also a black box of the extra bits that the schemes factor in, and that can be things like growth rates and future growth rates. So in an environment where markets have done particularly well over the long term, they can think, okay, we can bet more growth, and that can be factored into their calculations to look at, how they offer transfer values. I've also seen elements when age can impact it. So it can be that scheme trustees can adjust the parameters, and it might be that a younger member could have a higher transfer value or a higher calculation towards it because that's going to be a longer liability for the scheme. So there's little nuances like that you don't perfectly know the answer to because it is hidden in their actuarial calculation. But in general, it comes down to interest rates and annuity rates, which are linked, and then life expectancy and that future growth rate.
Yeah, absolutely.
One of the questions we had as well was to do with the £30,000 limit on an individual being able to move a safeguarded benefit pension, such as a DB pension, across. And the comment sort of mentioned the fees that they've been quoted, thinking it was quite high. I think it's a really interesting one because as a pension transfer specialist, we look at it and we know that there's lots of valuable pensions and valuable benefits that some people might go, I'm willing to give that up because I want to move away to the flexible pension, and maybe I want to use it now to pay off a mortgage or do something else. The government would say that's not in your best interest, or the FCA might say, actually, for a long-term retirement, a pension should be looking after you, for the whole time, not being used just now to solve a short-term problem. So that's why that limit, was put in place originally, was so people didn't accidentally transfer away valuable benefits without understanding the implications. I agree with the comment that probably that figure should be higher because there is an advice gap where someone with a £31,000 transfer value is going to struggle to find an advisor who will actually give formal advice because of the legal implications and the cost involved. And if someone is willing to do it, a bit like the commenter described, the cost can be quite high. So I think there was a proposal that I saw that limit might go up, and it was being looked at, but there's been no progress made on it. There's been no figures talked about. And I think it might be one of those things, a bit like the pension dashboard, which might be talked about for a good few years before we actually see any movement on it.
Yeah, I mean, I think with that one, the DWP had confirmed that they were looking at reviewing the limit, but never actually said exactly what it was. And yeah. I think there maybe were sources saying that they were going to put it up to 100,000, but equally we don't do financial planning on transfer rumours or something like that. So it's something we need to look at. I think, to be fair, looking at the actual comment there of he said he was quoted 4,000 to transfer a £40,000 pot. It's high. It's a very large fee. As you've mentioned, there are obviously reasons behind that.
Yeah.
Because when you do look at this sort of transfer, the FCA deem it as a high-risk transfer because you could be moving away from guaranteed benefits to a pot which, I don't know, could be lost over a weekend essentially. So
yeah.
By entering in that, costs can increase from an insurance point of view from the business. But I'm not sure. What are your thoughts on that, Matthew?
I think if that person was on the phone as an inquiry, I think you would be saying the PI insurance and the FCA would be saying it's in your best interest most of the time to take the scheme pension. So what's bringing you to the table to want to transfer it out? And then at that point, you're then saying the fees involved, in that example, they seem high, but it's because of the size of the pension, and really for a high risk transaction for the advisor, there needs to be potential to cover them for what is an ongoing liability of that. So most of the time I would be saying to that individual, it's not going to be in your best interest for us to charge you those fees, but that's what the fee would be, and therefore we're not willing to recommend a transfer for you on that basis. And also you've got to say to someone with that pension, what they're looking to achieve. Is there not a plan B, a plan C? And I mean, we've talked about it in a previous episode. Sometimes preserving a DB pension and using a DC pension or an ISA or something else can solve the problem in another way. So I think the fee is high, but I think it's high because of the high risk transaction for both parties.
Yeah, and I think that's almost just another, I suppose, note on the board of why DWP are looking at potentially moving them up. But with that, obviously, there's potential increased risk. So it's an interesting one. I think it's something that will probably develop over the next few years.
If I was the person who was then to pick a new number, I would also worry, because if you pick 100,000 and then someone with 99,000 then transfers away from something guaranteed and valuable that they didn't realise what they were losing, then that person again could be knocking on the door saying, why is it not lower? I should have been protected. So again, you don't want to cause too much issues, but I do think, to get good quality advice on a pension like that, the fees will start to outweigh the benefit, certainly on a pot below 100,000, maybe even a bit higher. So It's about being sensible as well.
Yeah, absolutely. And I suppose final one with regards to DB pensions that we've got here is with regards to indexation. So on the previous episode, when we talk, to be fair, quite a lot about DB pensions, we talk about how they're guaranteed for life, about how they've got sort of indexation link in there. And someone just made a very valid comment of theirs is indexed in line with inflation, but not all the way. So they've actually got they get 75% of whatever inflation is, and it's capped up to 5%. So I suppose it was just a little bit of a talk around understand what your own sort of pension indexation is. And Matthew, do you want to explain a little bit about sort of why some DB pensions are actually capped?
Yeah, well, I think when we say guaranteed pension, we mean guaranteed because it's covering a lot of different points. We might say guaranteed because there's not a chance of it running out. Again, flexible pensions, you might take too much too early, or you might not have investment returns. So for that point, it's not guaranteed. When we say something's index linked, again, we're not necessarily saying it's going to track perfectly with inflation, but really it's going to be notching up and it's going to be going up. And as you describe, it's trying to just understand what level of index yours is mapping. There's lots of different pensions that make up tranches of DB pensions, and depending on different rules, there's been times when there's been, okay, this has to be CPI at 3% or has to be RPI at a higher amount. So there can be those almost complexities for how pensions have changed over the years, leading to different tranches, but equally, the reason why it's not uncapped is because that would be a lot more expensive for the schemes, and your contributions to a DB pension when you were working would have had to been a lot higher to account for the level of income provided. So, anyone who's got a guaranteed pension, a DB pension, knows they've got a really good pension. And some people might be frustrated and say, well, inflation was high this year and I didn't get the full benefit. You've still got a really, really good benefit, and I wouldn't complain too much if I was them.
Yeah, I'd quite like inflation on my pension, but unfortunately it's down to the individual funds on whether they outperform them.
If you earn enough and save enough, then you can provide your own, I guess.
Yeah, exactly. Next comment sort of moves on to, I suppose, talking about tax-efficient drawdown and something that we've spoke about quite a lot of, potentially drawing up to your personal allowance or potentially even drawing up to sort of the top of basic rate tax. And they essentially ask sort of, should I leave some of the taxable portion of the pension in my pension as personal allowances over time generally should increase? So I suppose they're alluding to sort of the current sort of tax allowances of basic rate and high rate. They've been frozen to April 2028, but after that, theoretically, they should go up. What are your thoughts on that, Matthew?
I think in theory they should go up, but I think we have seen a stealth tax over time where keeping those personal allowances the same way other things inflate with escalate in line with inflation, easy for me to say, almost means that people pay more tax. So if you were the government, would you suddenly allow that to escalate again? In theory, you should, but actually they probably quite like the extra tax revenue they get from it. In relation to the question, I think the first thing I would say would be, don't let the tax tail wag the investment dog. So your decision to leave money in a pension to draw at a future point doesn't necessarily have to be linked to the allowances and the tax at the time. More, when do you going to spend it, or do you have other income sources to use? If that person has an ISA that they've got sat there and it's a choice between, do I use my ISA or do I use the pension, then certainly use the ISA first, which is tax-free, and delay using the taxable pension income until you've potentially got more allowances to use. But if you just had the one pension, don't delay spending on the basis of the tax efficiency.
Yeah, I agree. I mean, if politics over the last 10 or so years has told us anything, is don't rely on anything to be as it should be. And
that's very cynical.
Yeah, maybe a little bit. Change the subject slightly then. Looking at annuities. So with an annuity, you can give over a portion or all of your pension pot to an annuity provider. Some people are a little bit concerned. What happens if that annuity provider fails and goes out of business?
Yeah, good question. An annuity, as we've described in previous videos, is a guaranteed income for life. You certainly wouldn't want to hand over your pension to provide a guaranteed income for life if there was the ability that that provider could disappear and your income disappear. So you'd be happy to know that that's fully protected by the FSCS. So you're going to have that income guaranteed for life. The sort of pension providers and annuity providers we recommend, again, we look at the long-term track record and the financial strength. So we hope that no provider would fail, but if anything did happen, then essentially the lifeboat scheme would step in to say, okay, can we move this book of annuities to another provider? And that, FSCS scheme would then provide the funds to allow that to happen. So logistically, it would be painful, and you might miss a month's worth of income payment while it's being sorted out, for example. But in reality, no annuity provider or pension provider could actually get to the point of failing without the regulators being aware and then going, what's our plan to protect the individuals? And there is sufficient protection in place.
Yeah. Absolutely. I think you've got a couple of questions just with regards to the cash flow planning episode that we did, Matthew.
Yeah, definitely. So again, we talk about cash flow and we like the ability to model different scenarios. One question we had come in was, are there any provisions for care home fees, and how can that be planned with cash flow modelling?
Yeah, I mean, I think with all cash flow modelling, it's essentially looking at all of the what-if scenarios, and one of them is care home fees. Yeah. It's something that people are always very concerned about, but it's sometimes limited in how you can plan for it, because a lot of the time when we're looking at sort of a cash flow plan, we're looking at that sort of full and healthy retirement, and you don't necessarily know when you're going to go from that full and healthy retirement into a potential scenario when you might need care. Yeah. And in terms of planning for it on the planning side, when you know that you might need care, that really limits what you can do, because then the local authority could look at essentially saying, well, look, you knew you needed care and you've started moving assets away. It's essentially called deprivation of assets. We'll have that back. But in terms of sort of the wider planning of sort of inputting a sort of contingency plans for care home planning, that's definitely something that you can do with cash flow planning. Yeah. And other sort of ad hoc expenditure. We can look at sort of the regular cash flow plan, look at the sort of average time and the average cost of care and the average age, yeah, and then put it into the cash flow plan and look at sort of if we were going to have to spend multiple hundreds of £1,000s at some point, what would that do to the rest of our income? What are your thoughts on that, Matthew?
Yeah, I think the more we can put into the plan and the more concrete a plan becomes, the more value you can get from a cash flow model. The simplest cash flow model is to say, I'll retire at this age and I want this income for the rest of my life. Can I afford it? Yes or no? As you get into a real model with someone, it might be, I'm going to spend more in the first 10 years, then I'm going to drop some income, then I'm going to phase a little bit, and it's going to have like a few different phases to it. But I've had people in the past who've gone, I want to replace the car every 3 years, and that's going to be an extra 15 grand of capital. So I'll have my normal income and that'll spike up every 3 years. I've had one individual who looked at the cost of a private hip replacement and said, I'm probably going to need, a hip replacement, a knee replacement. Let's model that on a random year in the model. Again, it's what Joe described as the contingency fund, but it makes it a bit more real when it is a knee or a hip. And I think, the care home fee planning element, if we flip it the other way, someone might say, I know care can be expensive. Will I have enough to provide me the care I want? Yes, we can model that. But as Joe perfectly describes, if you don't know when or how much it's going to cost, that's the bit where it's hard to model. So yeah, we're good at modeling a plan. And we do stress tests. Again, we can have a husband and wife and we can say, what if someone was hit by a bus tomorrow? How would income needs be impacted and how would the various pensions flow through? So that can certainly work. And even little things like we've modelled financial crashes and the impacts of that on someone's withdrawals. So it can be very valuable from that point of view.
Yeah, I think it's interesting as well from sort of a wider perspective of cash flow planning. A lot of the time you won't use a cash flow plan to look at what the impact of care home fees will be. A lot of the time you might look at using a cash flow plan to look at what the impact of care home fee planning would be, because there are ways that you can look at sort of reducing your estate down for both care and inheritance tax potential liabilities, but a lot of them are restrictive. So it might be the case that you've gifted away assets or placed some in a trust of sorts. And in that case, you can look at, well, we want to avoid inheritance tax where we can. If we were to move 325,000 away by using an nil rate band, are we still able to achieve our retirement objectives? Yeah. So I think that's almost a good way of looking at it, of it's almost sort of a joint approach as opposed to only looking at the contingency of if you were to go into care.
Yeah, I also think that one of the most valuable bits on cash flow modelling is that bit of going, it's to be repeated, it's to model the ongoing journey. It's not a model that's here set for life. It's each year, where are we on the process? And I think the last question or comment we had before, which was brilliant, was, I might get it on a t-shirt, how can you plan when there's no clear deadline? And I think, that sums up financial planning when it comes to retirement perfectly, because you've got an opportunity cost of how much time have you got to live for and what do you want to do in terms of your, bucket lists and your retirement objectives. But equally, how long does your income have to last for and how can the two marry up? And if we knew the day we were going to die, we could do that perfectly and we could model it exactly. But because we don't, we have to build in flexibility and we have to model different phases. Traditionally we model to age 100 on our cash flow models, but then we might touch on average life expectancy from the ONS. Again, I've had some clients with health problems where they say, forget age 100 or forget your average life expectancy. I'd like to model the next 10 years, please. So I think that's where personalised conversations and objectives really come in to drive, am I using this pension over the long term? Am I using it over the short term? And again, we've had people talk about annuities and having a fixed annuity from a shorter period of time. Again, if that works for that person's scenario and what they plan to do, brilliantly, but it's not a one size fits all. And some other people might say, I had a client the other day who said, I'm happy to draw down income from my ISA, but I want to know that I've got 50 grand that's going to be available at age 100. Again, she doesn't expect to live to 100, but it gives her that peace of mind that I'm always going to have something available always throughout that journey.
Yeah, absolutely. I mean, I was going to summarise some of the key takeaways, but I think you've summed it up pretty well there, Matthew, in terms of, although you can't plan, it's good to plan for all eventualities and sort of work on that basis. Is there anything else you'd like to add just before the end of the episode?
No, I don't think so. I think we really enjoy the questions and the comments from people, so definitely please continue to share them. Please share this episode with a friend if you're able to. And if you've got any more specific questions that you'd like us to cover, please put them in the comments below.
Thank you very much. See you next week.